being equity guys at heart, we'll always have our positions wherever we see the opportunity.
What would happen if there is a black swan kind of an event? Is there a probability, first of all, of such kind of event happening?
Please go and buy euros, not the dollar, because I don't think the dollar is going to last too long.
Very good evening to all participants, and thank you once again for taking time out to join for another session on Market Pe Charcha with myself, Devi Prasad Nair, and Dinshaw Irani. So today we will discuss about whatever has happened, in the past month, and what we make out of that. And during the conversation, if you feel any questions which comes up in your mind, I would request you to put that in the chat box, and towards the end of the session we would be taking those questions one by one. And just straightforward, moving to what's happening around, more than domestic. I think domestic is not of a great concern, while the trade related news, which is coming with already a time extension, becomes the new talk of the town, and in a way it is sort of in one quarter we have seen of a lower corporate confidence in terms of their investments, and that we reckon that would hamper the growth which is in the future growth I'm talking about. This has happened in the past also, when earlier in the earlier regime of or earlier Trump administration, the same thing had happened, that immediately the effects of that were not visible, but 2-3 quarter down the line the effects starting to trickling in, and then it sort of disrupted the thing. So what's your take on that? Let's start from there, and then move to the domestic markets and Asian and domestic markets.
So basically, I'm assuming that you're talking about the trade overhang which is happening, the trade deal and stuff like that. Well, I remember last time saying that every other nation seems to be wondering what US wants, and they're not even clear what they want actually. If it's trade parity, what they're looking for, I don't think that's going to work. US is the largest consumer, and there's no way the world economy can satisfy, being on a trade parity with the US, because if that happens, then we don't need US currency, US dollars as a reserve currency. So basically, it's a catch-22 for them. If that trade parity happens, the US dollar will lose its charm as a currency of reserve, and the US inflation will run away, because from there on till today, what they've been doing is that since the currency of reserve, the repayment of interest has been happening by way of just printing currency and passing it on to whomever they own the money to. But if that goes away, then obviously there's a problem here, because once you print your currency, you're talking about inflation. There's no dollar reserve to back up that currency as such. So that's where the problem arises. I'm sure they also don't want that. Ideally, they should have done an effective depreciation of their currency the way they did in 71 and 85, if I remember correct. Even now they've done that to an effect, because quite a few global currencies are up as compared to the dollar. The dollar is appreciated effectively. I think if I'm not mistaken, won, it's roughly around 10-11%. So is the case with the yen, and so is the case with the euro and pound as such. So that's what's happened here. Having said that, the Indian currency hasn't depreciated, mainly because the RBI has been proactively trying to infuse INRs into the system, the markets as such. And they've been doing that effectively by buying dollars and supplying the rupee. So effectively, there's a demand for dollars and there's a supply of rupees. So obviously that is working in favor of the dollar, because you're sucking out excess dollars from the system, right? So that's what's happening here. But having said that, even on the trade front, the trade deals that they've done thus far, the one which they did with UK was just an eyewash. I don't think there was any difference in what UK had been doing till now and what they've been doing. So I think what they were given out, doled out as such. Only thing was a 10% effective extra duty that they applied on the UK. Same was the case with China, though they went away with not only the 10% extra duty, but also the 20% fentanyl tax that they applied on China because of the drug coming from there and so on and so forth. I'm sure that will go away also. So basically another 10% extra duty. Even the other places where they're talking about, like in the case of say Vietnam and all, again the same thing applied to them also. So I don't think they're getting any extra deals as such. Only thing is that Trump is trying to prove himself right by going about this. But please imagine the kind of uncertainty it has brought on in the US per se. I don't think that economy has gained steam. The equity markets have, but looking at the way the economy is functioning today, it's not looking that healthy as such. If anything, if this continues for a while, we're looking at a stagflation kind of a scenario. And even the fact that their triple B bill passed both the houses with a scraping margin. In fact, the upper house it passed with one single vote, and that also was brought on by the president, the vice president, who had the veto power in that particular house of Senate as such. So that's where it passed, and that bill is obviously inflationary. So you're talking about a pretty uncertain scenario out there, and that is what I think is playing out in the world also. Apart from that initial spurt that people saw in trade because they wanted to fulfill the 90-day deadline, I think things have come to a stall after that, and things are not moving that great in the world per se. So let's see how this pans out, but not looking healthy as of now. Having said that, in the case of our country, I think our deal also is stuck because of us. We're not agreeing to the terms that the US is bringing on the table. The last rumor I heard was the deal was through, but it was a very limited deal. But that's just a rumor. I mean, a hearsay which I read up in the press and certain areas of the press that had come up. That was a very limited kind of deal, only limited to textiles, pharma, not even pharma, sorry, to capital goods and so on and so forth. But the fact is that there's a 10% extra duty that has been applied. It's a temporary deal, if you will, and there'll be a certain deal coming up later, certainty of a deal coming up later, but not as of now. So that's what's happened in our case as such. So let's wait and see what happens. But I think whatever happens out here, India will come out with flying colors. But having said that, India's economy is the fastest growing. Our consumption itself will take care of the growth rate. So I don't see any problems with us.
So taking it forward from there, you mentioned that US may sort of go into a slowdown kind of a thing, right? Now, generally, if you look at most of the countries, like Asian countries, and most of them are catering to US consumer, right? So don't you think that it will somewhere hit the Asian economies also, and in a way India also, that we might also see some kind of a slowdown in the growth, due to US, right? Because people will be undecisive. Say for example, if somebody want to put or start a company, he doesn't know, like in US, I'm talking about, doesn't know from where to buy what, right? And he'll not be able to plan, and that sort of prolongs and sort of impacts the growth in US, right? And thereby the other countries who are contributing to that. So what do you think of this entire equation? How will that play out? And then you talked about currency depreciation also, right? I mean, which means the other currencies will appreciate. So how much are we estimating? What are we thinking that how much maybe a dollar would sort of depreciate, and or maybe how much of India or Asian currencies would sort of appreciate? Because that's a very positive thing, right? That if even if the other countries, they are going to see a slowdown, then that gives a way out for them, ex of China, because China already runs a very lower interest rate kind of a regime. But it gives a monetary policy tool in the hand of the central bankers in the other economies, to sort of react.
So basically, I mean, the stagflation scenario that we are talking about is the worst case scenario. We're not even hoping that occurs. Because if that occurs, we're talking about a global problem happening. China is already under a lot of stress, given that their economy has slowed down quite appreciably. Their CPP, which is their inflation data, is ticking up a bit, but it's not effectively anything. I mean, it's in the negative territory. So basically, their economy is shrinking, which is not a healthy sign for the world also as such. Yeah. And if the same happens with the US, you can imagine 40% of global economy taking a tank and how bad it will be for the world. So we're not even going there. We're saying that hopefully some better sense will prevail. US is much more stronger, and that's why they'll come out far better despite all these hiccups. They'll come out stronger at some point in time, and things will pick up. It won't be too rosy a picture, but it'll obviously be somewhere to start off with, right? So that's on the US front. I'll cover China separately because I have my own views there. But having said that, when I said that India, so basically, if obviously stagflation happens, everybody suffers, right? Forget Asia, the whole world will have a problem as such. By the way, the whole world is running a deficit. The US, I think, was running a 7% deficit. The EU region itself is running a 5.5-6% deficit. In fact, Japan also is now not borrowing. I mean, you can see their bond yield is going up to 3.5% So things are not that bad. I mean, they're not that gung-ho globally, but how you would put it is that things are probably primed for a growth, right? So that's how it is. Having said that, the Indian growth story is more of a growth story of homegrown consumption. I mean, our consumption has been lagging for a while now. It started off with the rural slowdown. The rural slowdown, in fact, came up sometime in 16, peaked out by around 18, picked up again. But then again, the slowdown hit quite sharply a couple of years back. I think it was 22 when the slowdown hit again. And then one saw a pickup again starting from last two quarters back. That's when the pickup happened again in the rural economy. However, the urban economy started tanking sometime in the beginning of last year. In fact, if I'm not mistaken, December of 23 is when it started becoming obvious that things are slowing down, right? And that accelerated into September, October, and never picked up after that. If anything, right now also the slowdown is quite very much there, but because of the YOY effect, it's not that obvious, right? I mean, the last year's numbers were low, so that's why you're looking at a low number again. It's not that sharp a slowdown. But our feel is that as and when the recovery happens, and I don't have any doubts that it will, and the reason why I don't have any doubts is that the whole reason for the economy to slow down was the way RBI was managing inflation. The erstwhile governor was quite aggressive in sucking out liquidity from the system to manage inflation. And as a result, what happened was, because of the lack of liquidity and obviously managing the banking system, the unsecured debt lending stopped, savings started shrinking. So obviously the consumer backed off, and he didn't see any new job creations. And obviously that lack of confidence happened. So everything got compounded, and there was a sharp slowdown. However, when the new governor came, I believe his mandate was to prop up demand. And the first thing he started off was by buying dollars and selling rupees. So that's the only way you can throw in liquidity without impacting the whole system per se. Yeah? You don't need to change anything. You don't need to tweak anything. And anyway, we had run low on dollars because our reserves from 700 billion had hit around 660 odd billion. And he had to build up the reserves. So this was the best way of doing it, right? So that's what he started off with. Then the government came with their fiscal measures by upping the slab of taxes from 7 lakhs to 12 lakhs. And that was a major positive, sentiment booster rather. But as I said, that things were very slack at that point in time. RBI on its part kept on cutting interest rates, kept on infusing liquidity by way of not only buying dollars, but from here on, more monetary measures like cutting off on CRR and releasing excess liquidity in the system. In fact, the last meet, people call it a bazooka from RBI, but I call it a bunker buster because the 0.5% cut and 1% cut in CRR was, I don't remember in my living memory, a RBI governor being so aggressive in one go. And it's obvious that he just threw in the towel and said, look, I'm putting so much money. I'm making it cheaper for you to borrow. So please come and start consuming, right? So that was his last bit call. And in fact, he's changed the stance afterwards from accommodative to neutral. And my belief is he did so, but later, by the way, he came and said that, look, I can still cut rates. It's not that by making neutral, I'm not going to cut rates. But why he did so was because, and rightly also, because I think they believe that globally things are not that great. And if you want to plan for any contingency which may occur because of global issues, then you might as well have some reserves lying with you to take care of. You should have some firepower left for you to cut or to move in more liquidity and stuff like that, right? So anyway, even before this CRR cut, which is going to be effective from September onwards, the excess liquidity in the system is around 2 lakh crores, which is huge. I mean, there's no doubt. But this is a lean season. And why they timed it with September was because they wanted the flush season to start with a reserve. So basically the festive season starts then, right? So that's what my feeling is, that the consumer will probably wait. He'll wait for a healthy monsoon to go by. He'll wait for inflation anyway is down. Inflation anyway low, right? But he'll wait for a monsoon to go by. He'll wait for inflation to be much lower than what it is today. 2.5% is what we're targeting actually in inflation. And and obviously the healthy yields and all will work out perfectly. And then comes our festive season. Normally, our consumers are normally very benevolent during the festive season. If they haven't bought an AC for a year, they'll say, okay, I might as well buy an AC or a TV. My model is old. Let me buy a new fridge and stuff like that. And if that happens, then you're talking about the private sector also kicking in, because the private sector has been waiting for demand uptick to happen before taking a call on capital expenditure, on capexes. And once that capex kicks in, we're talking about party time again back in CY26, because this whole festive season is what holds the whole key to the growth in India. If personal consumption kicks in, that is where you come from, right? The second question you had within that same question was about the dollar and where we see the INR vis-a-vis the dollar. And our feel is, if RBI had not done what it did, the dollar would have already, and the rupee already would have been stronger to the dollar. But I have no doubts in my mind, if the way the US is going, that it won't be too long before we see a sub 80 kind of a dollar to a rupee as such. So, and obviously that's because globally things have happened. I mean, if I'm not mistaken, won is up some 12% vis-a-vis the USD. Why it shouldn't be India also doing the same? Because India anyway is a net exporter to the US and stuff like that. So let's see how that works out. But this is what my feel is. So if any of our guys, and this is not a recommendation, is looking at buying some Forex or something, please go and buy euros, not the dollar, because I don't think the dollar is going to last too long. So that way.
Sure, then sure, that helps. Another question is that, coming to, what we've been doing. So we have taken a stance, we have sort of stayed away from technology as a sector. And, most of the time we meet our partners also, we get this question that what are we seeing, and, and which the market is not able to see, which has, made us take this decision, and stay out of tech. So your comments on that, Diksha?
So basically on the tech bit, I think normally, and I don't know, I mean, we are probably too early to jump the gun. Probably that's what our problem is. I won't say we are contrarians, but we see it far earlier than the others do. And I believe that's purely the experience that we've seen this before. So basically, how does it work? It works in the sense that today, the IT sector, okay, has been not only today, the last 30 years has been working on this three-pronged equation, which has worked perfectly well for the last 30 years. And that equation is fairly simple. Number of people, hours spent per person, into hours spent per person, into the rate per hour. That's the pure equation that we worked on. With AI coming in, you're now getting questioned on the number of people that you need for a project. You're getting questioned on the number of hours that you need per person on that project. I don't know, I mean, the rate, I don't know how much that rate can compensate for those two parts of the equation to get satisfied. TCS will come out with numbers today. I'm sure the numbers are not going to be as gung-ho as the stock price was not too long back. But anyway, whatever it is, I think there'll be some clarity coming through. So basically, we need some clarity on this, with how AI will disrupt this industry. It is going to disrupt. I don't think it's going to be assist on the industry. So one is that. Secondly, look at the state of the US today. As I was saying, that with so much of uncertainty, which business will have the guts to spend on technology right now? Even if they spend, they'll be only on maintenance of their existing systems, rather than on beautifying the systems or having a customer-facing upgrade and stuff like that. That's not going to happen. And that's where the discretionary spends were. With discretionary spends moving away, you're talking about margins moving away. Already you're talking about, I mean, you've heard from all the participants that the timelines of contracts have shrunk. The process of decision making has got extended. My feel is that most of the CTOs, the chief technology officers, who are deciding the budgets, they are basically maintaining the previous budgets because they don't want to lose their hold on the budgets per se, and that's what's happening right now. So I don't see much of growth happening. At least this year is a definite given, and obviously beyond that, nobody can take a call. But we have to see how things pan out in the IT industry before taking a call here. So might as well remain away. And one thing that I think most of our investors have realized, that we work in a binary fashion. It's a 0-1 strategy with us. There's nothing like an underweight just because we don't like industry. If we don't like an industry, it goes to zero straight away with us. So that's what happened in our case, and that's why we're staying away from IT. Probably we'll take a view once we are more clear on that industry per se.
On the mid-cap fund, there is a question, so I'll take now questions from here. On the mid-cap fund, while there is a question which is that you have several stocks below 25 basis point, while we don't have though, so that I would like to clarify to the gentleman that we don't have stocks below 25 basis point. We have released the portfolio recently, but we have adopted a strategy of capping stocks at 3%. If you could elaborate further on that for the benefit of all our partners, that why are we doing that strategy, and how that will benefit the investors in long run, and and how will that benefit in a way to the investors also.
Okay, so mid-cap fund, by the way, first let me tell you the basis of the whole thing. So basically, it's not going to be a pure mid-cap fund. It's going to be a mid and small cap fund. That's what we had clarified at the time of the NFO itself when we were doing the pitch, and we stick to that. We want it to be a high beta, high alpha kind of a fund, and that's why it's going to be a pure mid and small cap. SEBI allows us, the regulator rather allows us to have 35% beyond the theme, right? So 65% will be mid caps, 65 or slightly higher than 65, so that I don't give sleepless nights to my risk officer. So it'll be probably 65 plus something, and 34 something will be my small cap universe out here. So that's one. Secondly, we were very clear that we need risk control, massive risk control in this particular segment, right? And because mid caps and small caps by definition are supposed to be risky, high beta, so it has to be risky, right? So here's what we did. We said we'll have a cap of 2.5% in mid caps and 1.5% in large caps. Buying, fresh buying. Let them rise to whatever levels, but we'll start trimming them as we feel the things are becoming much more dicier. Okay, so that's what we had given a thought on, and that's why we're maintaining it that way. The number of stocks are high because of one, the risk control, and secondly, I remember when we were deciding on what kind of capacity we want to build into this particular fund. I remember Samir said that I won't settle for anything less than a 5-figure kind of a in crores figures capacity for this particular fund. So we worked with a initially a 10,000 crore kind of a capacity, and that's what we're playing with today. I have no doubts in my mind maybe that this will be a 10,000 plus crore kind of a fund for us going forward. And touch with the performance also has been good out here. Even after the recent classification changes which happened, two of our stocks, which are mid-cap stocks, turned into large caps. Being true to our label, in fact, we had now 3 large caps in our portfolio. So we decided to trim 2 of them and keep 1. And you'll see that the next changes, you'll see what's happening here. So basically, we'll stick to the label of being a pure mid and small cap play. 1 or large cap will be there because of the reclassification and nothing else.
Then you're coming to the balanced advantage fund. Now, we're seeing volatility, right? We've been able to, so our strategy was to, use sort of equity and arbitrage, right? While the market runs with equity, arbitrage, and bond gains. Now that, we are sort of nearing or hitting the bottom on the spread earnings, right, from the bond side. How do you see from here our BAF, which is, we have made changes in terms of the net equity levels also. So how do you see our BAF, doing, if say from here to next 1 year perspective, how do you see our BAF kind of, delivering vis-a-vis the market related BAFs which are there?
One thing we realized, Devi, is that the BAF investor is a different category altogether. He's not the regular equity investor. He's looking at safety first, and obviously he's looking at returns which are greater than the fixed deposits that he's put his money in. So obviously one thing is to safeguard his principal. The second is to give him a return greater than that of the fixed deposits as such at that point in time. So probably we'll play it with that, but being equity guys at heart, our feel is that stability is one thing that he needs in the investment process. And as a result, you've noticed that BAF per se is the equity portion of BAF is more of a large cap heavy. If you remove the ARBs out of it, it's more of a large cap heavy kind of a portion. And that's why we believe that we want to keep it not a low beta, but a reasonable beta with a reasonable alpha, which will ensure him that he gets his returns greater than not greater, but far greater than the fixed income that he's looking at. So basically, it'll be a debt plus kind of a fund rather than a debt plus kind of fund, and that's what we targeting to do. Having said that, as I said, the equity guys at heart, we'll always have our positions wherever we see the opportunity. And as a result, the 65% requirement for equity in BAF for it to classify for equity taxation, that will always be more than that, right? In fact, today I was checking, it was 86% or so, 87, 86% or so. Rather 89 if I'm not mistaken. So that's how it will be, right? And so it's always been greater than 65. And secondly, the net, as in the balance part, the equity, pure equity part, I think we're going to keep it at in the vicinity of 65 to 70% as such, because we believe the market is in a consolidation phase. And our belief, as I said, stems from the fact that it's a matter of time before consumption picks up. And once the party starts sometime in the last quarter of this year, we don't want to be caught on the wrong foot. And that's why we're going to keep the net high in our balance advantage fund and probably play it with that as such.
So Dilsha, so we've been talking very optimistically that things would be good. What would happen if there is a black swan kind of an event? Is there a probability, first of all, of such kind of event happening due to whatever is happening in US? Maybe something somewhere blows out, and do you see even a sign of that happening?
So basically, I don't think what's happening in the US is a black swan. I don't. So
not
why
the black
is
swan, that leading to a maybe.
Yeah. So no. I'm saying that even a stagflation is not a black swan. It's a black swan is basically an event which is not predictable, which just comes out of the blue, right? I mean, That's why it's called a black swan, because there are no black swans in the world. There's only white swans, right? A black swan just appears from nowhere, right? So that's how it should be. So in my case, a black swan would be a nuclear device being blown up by Iran or China taking over Taiwan and stuff like that. That would be a real black swan event. So what's happening in the US is not really what's worrying me. I think there the heads are much more saner than what they portray it to be. If anything, Trump is a very shrewd negotiator, and that's why the taco trade works in US, which is Trump always chickens out, right? That's what the taco trade is all about. And that's mainly because he knows what is good for himself, what is good for the country as such, and he backs off whenever he realizes that nothing is working. In fact, he got a very well stuck onto his 9th of July deadline, but seeing that apart from 2 or 3 deals that he did, he realized that it has to be extended. So he's extended until 1st of August. I'm sure that deadline also will get extended, though he keeps saying that, no, we'll stick to that as such. So that also will get extended. So I don't think that's going to be the case. I think we're going to come out of it a bit bruised. But please understand, if the world is beaten up, we'll come out with probably a bloody nose. That's about it. And we'll come out much stronger. We'll recover it from much faster than what the world will take time to recover. And that will put us on a more stronger footing, if you will.
Coming to another question, which is there from one of the investors, partner, and which is about that he's been talking to people, and what he's trying to tell is that the companies are actually sort of pushing products to the distributors, which means they're just dumping it at the distributors end. And about what he's saying is that about 40 or 50 odd % of that gets only that gets sold in a month. So he's saying, and plus he's talking about the personal inflation numbers, that has gone. I mean, anyways, that has to be checked. But the big picture thing, that we have also read, or learned from the past, like, when the auto thing happened, we saw the auto body coming and saying that, for almost a month, sort of almost a year rather, the auto companies were sort of dumping the, inventory at this distributors end, and there were no takers, right? So what are we making out of this? Do we see these kind of things happening? Because we're very bullish about consumption as a theme, or discretionary consumption per se, because whatever is done by the monetary policy rather, would eventually get into that thing that, consumption would slightly start ticking up. So what are we making out of this thing? That is this happening genuinely? Is the stocks moving out, or is it like, moving out with a lag? I mean, what are our research teams?
So basically, there is some truth to this. I think mainly it's in the auto space, where the autos are getting pushed to the distributor. But our feeling is that the last month, the June month, was a reset month, after which one saw that even the automobile dealers association, FADA as they call it, Federation of Automobile Dealers, they came back and said, look, the inventory levels have gone down, thanks to the fact that the auto companies have pushed back. Mainly, this is a phenomenon which happens at the end of the year, because everybody wants to meet their target. So the dealers are pushed with inventory, and they're asked to sell whatever is unsaleable, right? This doesn't happen in other industries, because other industries don't carry those kind of inventories which our auto industry carries. Each car is a huge thing to carry in your showroom, right? So they have these huge warehouses outside where they're supposed to put the cars. So that's what happens there. But otherwise, it's not the phenomenon here. As I said earlier, I don't see any offtake happening right now. My whole belief stems from the fact that the way RBI has gone about pushing liquidity in the system, the government has gone about helping and increasing the savings of people by increasing the slab in taxes. I think that is like a fuel which is lying on the floor, ready to be lit, right? If you guys remember Ben Bernanke, the erstwhile chair of the Fed, as such, he was very vocal about this. He said, look, recession in the US is never a problem for me. because my currency is a currency of reserve, and all I need to do is print dollars and probably throw it from a helicopter. And when it hits the ground, people will buy. They'll take the money and they'll buy it, because for me, printing is free, right? And that's why, by the way, his title is Helicopter Ben. Now, I don't see any difference here again in India, because if anything, even if so much of liquidity was to be infused, and by the way, this is without printing any dollars. We are predominantly printing any currency. We already have that reserves lying with the RBI. They're just putting it back in the system. You've seen the interest rates drop sharply. You've seen savings becoming redundant, because earlier the savings used to earn an X%. Now they're like X divided by something %, right? And the savings are bound to get out of the system %. And that's what's happening here. Liquidity itself brings its own demand. And that is why our belief is that things will pick up. At some point in time, the consumer is bruised. He needs some kind of a comfort. The comfort could have been by way of jobs, new jobs getting created, salary hikes being given. Both these factors aren't working out, but I think the major comfort will come from the fact when the festive season kicks in. The festivities in India are always very nobody is thrifty during the festive season, and secondly, the money is cheap, so that money itself should come into the system, and that's what the whole thesis is. As I said, the acid test is the December quarter, the October to December quarter in terms of pure offtake. However, the positive sentiments will start from the September quarter itself, because if you guys remember, last September was the worst that India recorded in terms of earnings growth. There was a negative 8% earnings growth. The December quarter was a positive 3%. March quarter was a positive 5%. I don't see much hope in June quarter. I think it'll again be like positive 3 or 4 or 5% kind of a quarter. And September, because the base was so low, even if June continues its own pace, the June quarter continues into the September of this year quarter, the YY numbers will look very exciting. It'll be like a low double-digit kind of growth, 11-12%. And mind you, this will be coming on the base of a low single-digit negative and the low single-digit quarters as such. So it'll look very nice. And that's why that, again, the numbers will come out sometime in October, November, again coinciding with the festive season and the infusion of liquidity by the RBI. So I have my full faith. Obviously, there are many a slip between the cup and the lip, but the fact is that I have full faith that this scenario may pan out, just about pan out.
Then so let's now come to sectors and valuations. So, first, talk about some of the, sectors, and then come to the market cap. So, in terms of, we are overweight financial, right? And there is obviously rate cuts happening, which is sort of will have a near-term bearing on the banks. So what are we making out of that? I mean, how do we see that evolving going forward from here? I mean, the financials and especially the banks which we hold.
Basically, Devi, I mean, our what we see is normally what happens in the other markets also, right? That definitely repeats. Fortunately for us, there are quite a few markets where things have panned out the way things are supposed to pan out in India over the next 5 to 10 years, right? We're gonna be probably one of the fastest growing economies in the world. We're gonna be the third largest very shortly, and obviously we'll contribute probably a quarter of the world's GDP growth will be contributed by India, right? So those are the kind of things that we are looking at. And obviously such events happened in the US in the early 70s, Japan in the early 80s, the 80s itself, not early, the 80s itself, and then Germany in the 90s, and probably China from 2000 onwards took up the cudgels. So I don't see India to be any different. All these economies saw a massive run up in their BFSI space per se. And why that happened is because these economies ran up, and so will India, on the basis of their own internal consumption, right? It's not going to be manufacturing for outsourcing or for going to be investments and stuff like that into fixed assets. It's going to be pure consumption, which is going to be driving up the economy. And whenever that happens, the BFSI gets a double whammy for this, in the sense that you don't only need financing for funding the consumption, but you also need finance or funding the back end of that consumption, which is capex and working capital and so on. So I have no doubt in my mind that the BFSI space will be one of the fastest growing in the markets, and thankfully it's proven us right. And this year itself, BFSI has done phenomenally well as compared to the other sectors which have been laggards per se. And yeah, we continue to be bullish on that space.
Which other sectors, then, Shaw? I mean, other than financial, where all are we positive now that we are not sort of positive on tech? What's our view on pharma? Are we positive on pharma?
Pharma, I think again there'll be a lot of problems going forward in the sense that the way the US is approaching the pharma issue. In fact, I think the day before Trump made a statement that I'll apply a 500% duty on pharma. I don't know what happened to him that day, but it's not possible, logically not possible. But the fact is that he's targeting that space, right? So I don't think that's going to be that easy. Obviously, there's again a lot of question marks. We don't like any of the pharma names. We like CDMO space to an extent, but that again comes under question given the way US is approaching its own pharma. They want homegrown manufacturing rather than outsourcing happening there. So we like probably in pharma, we like, if healthcare, if I was to broaden it a bit, we like hospitals a lot. We think that's where your real growth lies, because that's a space which has seen quality healthcare lagging thanks to the fact that the Indian consumer didn't have the spending power. But now with per capita is moving up, his spending power also moves up. And obviously, the first thing that he's been neglecting was quality healthcare, and that will obviously come up. But that's not the only space we're playing quality healthcare with, rather hospitals with. We are also playing it through health insurance. We think insurance has been underpenetrated, health insurance, and that's going to come up a bit. So that's why these additions of new names that you've seen in our portfolio per se. In the hospital space, one more thing I want to clarify is that the RPOBs have shot up. That is, average revenue per occupied bed has shot up quite appreciably for most of the hospitals. And I don't see that trend changing even going into the future quarters. As I said, that this quality rooms there's a paucity of quality rooms. And that's why when the demand goes up, this revenue stream also goes up for per room. When that happens, the break-even levels for the new hospitals comes down sharply. And normally these hospitals, the new rooms, used to break even after 18 to 24 months. They've halved literally to 12 to 15 months now, the break-even levels. And that's the positive sign for most of the hospital guys. So they can set up capacities and earn money faster. And I think that's what's going to give a multiplier effect to the hospital sector. The other sector that we like is hotels. Similar to hospitals again, the fact is that quality rooms are very much scarcity. Under scarcity, you can imagine, I mean, from last year, I think the ARR is up roughly around 40-50%. In some of the hotels, more than 100% as such. So that's what's making it excited out here. Again, capacity additions are not coming by that sharply. So there'll be fun times happening in that particular sector too.
So Richa, CapEx, government, they've been spending, and they are like up in terms of about, I think YTD about 36 odd percent. On a YOY basis, also a large part of that has gone to defense. So what's our stance and outlook on that particular sector? I mean, and other than that, what's our outlook on energy and energy and other pockets? Which are the two big themes which we are looking? One is obviously financial, we talked about. Which are the the other one is basically retail, largely retail, which we are talking about, and
consumption, yes.
Travel. Yeah, consumption, right?
Consumption not by way of your FMC.
Retail and travel and luxury, right?
This is
basically
travel, luxury, healthcare, all these areas which we classify as consumption. I think this is basically the big ticket consumption that we're talking about. Discretionary can be big ticket, but our problem with autos is one, autos is the biggest discretionary that you can think of, right? But the autos problem is, one is that we don't like the EV onslaught in autos. Secondly, by the way, you can always argue that EVs haven't given a dent to autos thus far. But my feel is that, look, the playbook has been set by the two-wheeler guys. They suffered a lot in the EV onslaught. I don't think our PV guys, passenger vehicle guys, have seen that onslaught, mainly because of the fact that they've been insulated from a global flow into EVs as such. And with Trump being truant, this is what he's targeting for Indian auto space. He wants EVs to have penetration in India. So I think there'll be a big question mark out there. So this is what we're playing it with. And in terms of defense, the problem with defense is that most of the consumables in defense, be it say planes or be it say ships, the problem is the capacity of the existing players is fairly limited. They need to expand capacities, and for expanding capacities, you need a huge amount of capex. You need a big gestation running to 2-3 years. I think the stock markets have already discounted these guys for 10 years down the line, right? And that's why we don't like these kind of plays per se. And I have no doubt in my mind that India will become an outsourcing base for defense for the world. And obviously, BEL will be a big beneficiary because this is technologically advanced defense electricals that they're talking about, and that'll work out perfectly for us.
That's insightful. Last question on the valuations. Every month we talk about valuation. We talk about it again. Where do you see the valuations? Heading. We are all there is very less of according to me, I think market is on most sides. It's sort of fairly valued, right? I mean, there is no large dispersions from the in terms of, or there are no large value pockets, right? So what do you think? I mean, do you think that the multiple expansions will not happen and it will be pure earning compoundings from here? Or what's your take on that?
So here's how it is, okay? If you compare to the last 10 years, the valuations definitely look stretched, right?
Yeah.
But 10 years is too long a time in a dynamic country like India. If you look at the last 5 years, we are at par. At par, probably we are at a 5% premium to what we were in a 5-year average basis, right? And that I think is more justified because the last 5 years is what is going to reflect the next 5 years. Frankly, I mean, if anything, India's growth rate is going to be much more stronger going forward. And this is across facets. The only pocket which looks very, if you were to optically look at it, is the small cap space. But unfortunately, the small cap space, the problem is people look at those 250 stocks and the 250 stocks in the index, and they take a call that, look, these guys are at 30x forward earnings, when in the past they used to quote at some 24, 25x. So they're very expensive, right? The problem is that these 250 stocks are not the universe. The universe is like an ocean, because anything beyond the top 100 and the next 150, which are the mid caps, everything else is a small cap. You can call it a micro cap, mini cap, whatever cap you want to call it. But the fact is, that's the ocean that you can dip in, and you can pick your stocks from that ocean per se. And that's why I don't hold too much in the small cap valuation space. I think one should look at their bets and take a call accordingly. Having said that, in the mid cap, again, we are slightly much more premium to the large cap, to the large caps as they were in the past. But that's mainly because if you take away, so the universe is 150 stocks, the mid cap universe. If you take away 30 of those in that space, which are like 100x value, then the valuation starts making sense. Basically, the world has re-rated us and re-rated us on the back of a high growth. And that is what we need to bring in again. I have no doubt in my mind that the growth rate will start kicking in probably from the September quarter as such. And the real pickup will happen probably in FY27 and not FY26. So that's what our feel is.
Then Disha, thank you very much for your time, and thank you very much, partners, for your time. I'm sure it was informative and insightful for you, and we will continue our engagement with another session of Market Pe Charcha in the month of August. And till then, take care and thank you very much. Have a nice evening.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.